We have about 80% of our bank ratings on a stable outlook globally, and that's, I would say, despite the monetary policy tightening in the face of stubborn inflation, despite the economic slowdown in front of us, and also despite the many geopolitical incidents around us. But one of the main reasons for the stable outlook is that this is very much a long-awaited downturn that we have in front of us, and that's why we chose this title. Forewarned is forearmed for banking outlook this year. In a way, no one is caught off guard this time that we are facing a slowdown in the economy. We see examples of that in the provisioning of banks. Many have retained some excess provisions from the COVID years, although COVID didn't turn out as bad as expected in terms of asset quality. There's a bit of a buffer here. Another example is around capitalization, which has been on a upward trend for the past 10 years. And regulators have been aiming for the past decades to prepare banks for stress scenarios that could be actually much worse than the one that many are expecting now. So another reason also is profitability. Higher base rates means higher pre-provisioning income for many banks, and that boosts their ability to absorb some expected increase in the cost of risk. But the question is, or the billion-dollar question is, how much worse will asset quality and provisions get for banks?
Let's look at some of the numbers that you have in the report. You're saying that as of October the 31st, 79% of bank rating outlooks were actually stable. But what I would like to understand is what regions could surprise on the downside.
Sure. The average is always high, some difference in the regions, and we see some sectors and some regions under potentially more pressure. Obviously, there are questions around the potential wildcard of CRE and the impact on asset quality. So from this point of view, the US, we can see a bit more divergence in the creditworthiness of some financial institutions in the US. Obviously, in China as well, people are waiting to see what will happen with the property markets. We expect that we will see the light at the end of the tunnel soon, but a further correction still next year. So what does that mean for more concentrated or smaller lenders? So these are two regions, for instance, where we are watching and expecting a potential divergence in the creditworthiness of many financial institutions. But that's true in every region. Even in Europe, I think when the monetary policy tightens, we start seeing more differentiation in the credit health of many financial institutions.